Do not, for any reason, ever share your private keys, passphrases, passwords, or click suspicious links. Everyone all the time is trying to steal your stuff, so go slow and be careful. There's no point making all this money just to give it to a thief.
Are you tired of all the uneducated noise you're getting from the droves of YOLO meme coin peddling douchebag gurus out there trying to use you as their exit liquidity? Would you rather learn a competent university-level set of skills that will guide you in managing and investing for the rest of your life? Join us 3 days a week at Digital Investor. Develop your knowledge of game theory, cognitive bias, macroeconomics, monetary theory, investment theory, psychology of the crowds, and more. For more info on Digital Investor and how it can help you, reach out at nickblacknext.com.
All right. Hello. Okay, I think we got about 50 people. So we should have 50 likes. We will trade your likes for free content. Woo woo. See, isn't that awesome of us? Doing big things. Let's see. Good morning. Okay, I think we got everybody. Good morning. All right. Okay, I don't think we have too much housekeeping. I mean, I'll show you a hint at something. So most of you know that we are for hypercycle, that we are working on a couple of things that it would be pretty cool. Some markets, so to speak. So I'll let you just take a quick look. But it's still in development, so don't go banging around on the website. But anyway, here, I'll show you. There. And basically, what you're going to have over the next, 4 or 6 weeks, depends. There's a lot of stuff that we're just waiting for that we can't do. We can only do so much. But you're going to have a place where you can buy node licenses. You can sell node licenses in various stages. For instance, you might have node licenses, just licenses. You want to resell them. You might have licenses that you want to put to work. You might want to buy licenses or you might already want to buy or sell licenses that are currently in production in the ecosystem, developing their reputation and uptime and compute and earning money and all that, like little businesses. There's no reason why you shouldn't be able to sell your little business or go in and buy a business. Know what I'm saying? So these things will all be available. Now, again, this is not ready yet live. We have a lot of plumbing we have to do. You'll notice there's like a little gas checker up in the top right, just beside where it says connect your wallet, where you can check the current gas. There'll be a full market, full exchange. This is also going to have an OTC for general token swaps. You'll be able to swap every token. So we'll roll out the different contracts at some point. But anyway, so that's over the next 4 to 6 weeks. So that'll be kind of fun. All right, so there's the housekeeping on that side, the hypercycle node side. And again, if you're curious, like right now, if you want to buy nodes, it's easy. You just go to nickblacknext.com and you just cruise on down here where it says hypercycle nodes and you click on it And that's it. You can like get them. So see where it says cart empty? You could put them in your cart. And there's even a little cute video that tells you how to do it. So cool. Anyway, so yeah, so that is that. Anyway, it's very easy. It kind of walks you through it. And don't worry. This is a little thing that's just the difference between digital investor and digital private client. People are like, what are they? Well, you just scroll down, man. Scroll down and you see the little X's and the little checks and all that kind of cool stuff. Yep, that's it. So anyway, yeah. Woo-woo. It's all right there. Okay, there is that. We've done all the old housekeeping we need to do. Hopefully my camera won't get all freezy and weird. All right, let's get some just basic Q&A out of the way first, and then we will get into the guts of it. We're going to talk some microeconomics today. Oh yeah. Oh, it's got the big list. It doesn't have my favorites because I have to log in and I can't log in on screen. Look at the Bitcoin getting its ass kicked. Well, not really. 25.8. It's not terrible. Let's see. Okay. After putting an asset into an unbonded vault on Singularity DAO, please explain the options. Harvest versus the other choices. Okay. That is a good question. Let me see if I can just pull up Singularity DAO. Unbonded vaults. Okay. Let's see. Let's pick a vault. Oh, it won't let me. Okay, so your choices on any of these. So just so you guys know, at Singularity DAO in the unbonded vaults, which means you don't have to lock your tokens up, you would simply go here. You would connect your MetaMask or comparable wallet. MetaMask is my favorite. Where the tokens are currently residing, right? These are either ERC20 or Binance Dumb Chain tokens. So anyway, you would connect the wallet. Click, yay. I don't have any wallets connected to this computer for obvious reasons because it's the one that I do broadcast and I'm not a dumb idiot like the guy. There was a dude last week on YouTube that was doing a podcast and exposed his private keys like a jackass, and they pilfered him. His own viewers pilfered him for $60,000. Dummy. Anyway, don't do that, man. Everybody wants to steal all your stuff. My luck, it would be the one person that comes in here and does the down thumbs, like the little passive aggressive D-bag that does that. I don't really care, but not dwelling on it. But anyway, so you connect your wallet. Once your wallet's connected, you choose the asset that you currently own. You can stake, which requires two. You have to approve the contract. Once it's approved, then you stake your tokens. Now, harvesting. So, okay, let's go from the beginning. Withdraw. If you withdraw, you're taking everything staked and unstaking all of it, right? But the rewards would still be there. If you do harvest, that is just taking the rewards, right? So withdraw takes the tokens that are staked. Harvest is like harvesting the plants that have grown in the farm. You're just taking so harvest just takes the rewards and scrapes those back to your wallet. Withdraw and harvest takes both piles and puts it back into your wallet. Does that make sense? So let's make sure we've got that. So if that makes sense, yay. So what I normally do is every few days when I have a pretty good chunk, and remember, you don't want to be always harvesting and taking your rewards because you got to do the math and make sure you're not paying more in fees. You know, with Ethereum, it could be very expensive. So if you're harvesting every day and you don't have millions of tokens, you're actually losing money because you're burning them in fees. Remember, it's two. If you want to do anything with a token, you've got to harvest it and then you got to do something with it. Even if you're going to restake it, harvest and restakes 2 transactions, bro. 2. Now on Binance Dumb Chain, that's cheap. But on Ethereum, not so cheap. So you have to make sure you're factoring that. And the way to factor it isn't like, oh, I earned this many tokens and it cost this much. No, the way to factor it is, what is the percentage yield I'm earning? And does that daily yield, break it down, you have what 4% is, right? So you can get what, let's say you have something that's collecting 4%, new net, 4%. Over the course of a year, 4.43. And you have 1 million tokens. You're going to get 44,300 tokens. Divide that by the days and make sure that the amount you get per day, which is tiny, is not completely exhausted by fees, because even if you're restaking it, you want to make sure that the daily amount, that it's worth the effort to do that whole circle, right? To harvest, stake. All right, just do the math, man. Make sure you guys do the math. A lot of people, I see them, they're over harvesting and staking. They're like, yeah, I'm earning rewards. But the number doesn't really go up, because by the time it's all said and done, they burnt more in fees than the excess rewards they'd be getting. And also, so make sure that the new amount of tokens, it's earning enough to justify the fees, not the total amount. Hope you guys kind of get that. All right, cool. Yay. All right, what's going on? Let's see. Jerry. Hello, Jerry. Have you heard anything about dust on midnight? No. Cardano has been kind of quiet about that. So yeah. And actually Cardano, the token's been getting its ass kicked, which is actually pretty good if you're long the token. I saw an interesting comparison where, again, it's a zealot, religious Cardano believer, follower, all that. So you got to, put on your, rose-tinted Cardano glasses, your bluish rose-tinted glasses. But he's comparing the kind of the beginning, the middle, the price raise, the crash, the timeline of Cardano. He's comparing that to Amazon. I think that is a wildly mistaken comparison, but I get what he's saying. I guess his heart's in the right place. Let's be honest. Cardano is not Amazon. We don't know what the Amazon of the crypto space is. We don't even know if there's an Amazon of the crypto space. That might just not be a fair argument, or even like a way to visualize what's going on in the crypto space. Probably a very flawed look. It's not like everything in the world is going to be reproduced in the crypto world. Everything you see. It's not like, oh, what's the pets.com of the, well, probably that was the NFT space, but it's not the same thing. So I just think people are maybe overly optimistic for the wrong reasons. Now, the reason to be optimistic about Cardano is that they are the only entity that is constantly pushing code and upgrades, and they're constantly building the developer community and releasing tools and scaling. And everyone, well, not everyone, but most of these other projects, they just rely on other projects for their scaling, which is a very weak way to do it. Like, how does Ethereum scale? It's easy. They don't. They just let other companies do it. Layer 2s and side chains. You gotta say, well, that seems lazy. Yeah, they rich, bro. When you're rich, you don't give a shit. It's weird. You just wake up with no give a shit in the tank. You wake up at the crack of noon, ready to tackle the world. Oh, I got to go get lunch. Oh, I got to go, whatever. Anyway, so the only team that doesn't seem to be sleeping and coasting is Cardano. And that's a good thing. And we're still early, so I would say give it some time. That being said, if you held a gun to my head and said, are you 100% certain that Cardano is going to make it? No, we're not certain any of these projects are going to be the final iteration. But the cool thing about Cardano is that they keep improving, and they are big fans of peer review. Publish first, not build, break a bunch of shit, and then not apologize. You want to know how much money has been destroyed, melted, sent into hyperspace in the Ethereum ecosystem? A dump truck. All gone. See you later. Bye. Never to return. Hell, there's $150 million in a burn address. I mean, that's literally never coming back. That's not, no one even gets that. It's not, you don't even get to steal that and get that. So a lot of building, a lot of GitHub submits, a lot of work going on in the Cardano ecosystem. But you know what? They're not asleep at the wheel either over at Cosmos. It's just, it doesn't really look like I don't feel like they're getting any traction. I don't feel like Algorand's getting any traction. And they can say to their 6 people that they communicate with, apparently, that, oh, we have all these enterprise deals. Well, that's a bunch of bullshit fruit that they dangle. That's a carrot that the enterprise deal fruit that's the carrot all these D-bags dangle. It's the same thing that Ripple does. We have all these deals. We're getting ready to flip the switch. There's no switch, dumbass. Why don't you flip your way out of federal court? Oh, wait, you can't even do that. Shut up. And then you have, oh God, David Schwartz. He drank the effing Kool-Aid. The other day, he's the CTO of Ripple. I believe that's his title, unless they've changed it to something even more fancy. All those titles are bullshit, by the way. But anyway, he's the tech guy, and he's really smart. He's cool, except that he started to go into the world of whimsy. Like, did you know that they're throwing a party to celebrate the victory over that the SEC appealed, but they got found guilty of violating securities laws? So, like, I don't know what kind of party that is. That's like like you're in prison and you win your appeal, I guess, but you have consecutive life sentences. You're like, I won my appeal on one of my life sentences. They're like, sweet. They're like, I mean, they did still find me guilty of murder, so I do have to stay in prison for this other stuff, but I beat that one. They're like, good, I guess we party or something. So I don't know what, I don't know if the team at Ripple do they think everybody's fucking stupid? They lost. They were found guilty. Like, I guess I don't get it. I'm the one person that doesn't get it. I'm apparently the only one. I mean, and you guys. So they're throwing a party like they won, even though found guilty of violating securities laws. Okay, great. But like, you can't kind of rewrite what's going on. But what all these companies do is they dangle to the super religious, zealotous followers. Because if we're being honest, all of us, 99% of this crypto space is bullshit. Really. There's tens of thousands of junk assets of people just launching stupid coins just to hoover up cash, a bunch of YOLO dumbasses, all the same NFT people getting their asses kicked. Yeah, biotech. I do hold XRP. It's a rounding error. It's such a small amount that I don't even feel like selling it. It's less than 1/10 of 1% of my portfolio. So yes, I still own it. In the way to imagine it would be, of my $100 of portfolio, I have 10 cents worth of XRP. And I'm going to hold it. My hands, diamond hands on my 10 basis points of ownership. So what these companies do, they tend to dangle this fruit of, oh, we have enterprise deals. This is what Algorand does. Big enterprise deals, big deals coming. You can't imagine how big. I mean, I can. We know how much money's in the system. So like I could imagine it being some percentage of the money that's in the system. Yeah, well, you can't imagine. We have exotic corridors where Botswana, what? So they do $6 a day in transactions. Yeah, and that's our market. Okay. And then Algorand's like, we're going to be working with the Central Bank of Italy. What do they do? $45 worth of bad debt a day? That's a bunch of bullshit too. It's the eye in pigs. They don't call them pigs because they're great performers. Like, God, man. So I don't know. And people get caught up in that stuff. And all these projects have a story. And one of the reasons why I gravitate more towards like Cardano and other layer ones. I mean, I really like Cosmos as well. I just don't know if they're going to kind of get out of the starting blocks, but they don't just tell everyone, wait for this big magical enterprise deal. It's coming. You guys are going to be rich. Like, do you remember the 589 bullshit in the XRP community? It's going to 580. So anyway, David Schwartz, really quick, let me just tell you how much of a jackwagon he's become and how much respect I've lost for him. He says he sees a future where XRP is the world's reserve currency. I don't like to use profanity more than I have to, but that, David Schwartz, if you only hear this 5 seconds, that is fucking stupid. I can tell you with absolute certainty, some rando asset. It's not going to be Cardano either. It's not going to be a layer one. It's not going to be the world's reserve currency. XRP is not a currency. The closest thing to a currency is a stable coin. And the only ones that can issue currency are governments with jackbooted thugs, War Powers Act, taxation, armies, nuclear weapons, shit like that. A side hustle company that was created out of thin air and hijinks and a bunch of douchebags kicked out of the banking system. That, by the way, 3 dudes owned up to 20% of the entire. Think about that. Think if some government told you, we're going to launch the world's reserve currency, and 3 of our founding members own 20% of the world's currency. You would say, shut up, dumbass. You would get laughed, that everybody would laugh at you till you just cried and fell into a little fetal position and urinated all over yourself. It's just so stupid. Like, it's so stupid for so many reasons. And then, like, you can't. So who buys into that? Just uber religious, zealotous people that don't have like a very good bar of like monitor for common sense. This is so stupid. And then that's the problem, is that's like 85% of the crypto space. And on the other side of it, that's also the best thing about crypto. Because really, you are investing against idiots. Most of the investing space in the crypto space are idiots. They do not understand macroeconomics, microeconomics, yield curves. They don't understand. They don't have any idea how repo works. They don't have any idea how basic finance works. They don't even know what their damn personal balance sheet looks like. They have no clue it's all YOLOing idiots. And I'm not just talking about the douchebag like Reddit mafia. I'm talking about like some of the people that manage money too, like on a big level. I know people with a lot of money. They dumb as hell. I know one money manager. He might be the dumbest. Is that fair to say? Might be fair to say. He might be the dumbest person in finance I've ever met. And I won't say his name, but I'll tell you where he is at. Is at Northwestern Mutual. They have 200. No, someone has to fact check this, but when I was consulting for them, they had 240 billion under management. Well, wealth management. These mother effers don't even understand the very basics of the bond market. They don't have a clue how money works. Why? Because in banking, you rise to a position of greatest incompetence. And your job title makes you do less and less and less understanding of the macro environment. So you understand, very little. To the point where you're just managing people. It's a sales job. Those jobs are all sales jobs. And that's great. They're probably great salesmen. But they don't know anything about the world of economics. So what do they revert to? They revert to their 1970s education. Their black and white school textbook education, where all you needed was a Phillips curve and everything else made sense. And that is just so tragically flawed, such a poor version of the world. Let's see. Can you put into perspective a hypothetical situation of putting 4K into hypercycle tokens right now versus putting 4K into the 8 nodes and needed tokens as the price of hypercycle goes up over time. Well, I don't know, Kevin, I'm not sure what are you saying a comparison? I mean, I'm not going to compare what the price might do over time. This is not that. That's more a digital investor thing when we're behind the wall. I don't even think I can kind of comment on the price. But I don't think it's one or the other. The way I look at my bag is I imagine kind of, let's say I had $10, and this is just a random, not advice thing, but let's say I had $10 and that was enough to participate in hypercycle. Then I would think $5 tokens. And then how do I get enough licenses for those tokens? So it's not an equal apples to apples, right? Like right now, let's call it 50 cents. So you're at $512 of tokens and then a node. This is let's say it's $110 or something. So it's 5 to 1, right? So if you had $10 at 5 to 1, then you're going to have, for every $5 of tokens, $1 spent on nodes. Again, that's just like kind of a ballparky figure. So it's not like this or that. It's a percentage. I'm just always thinking, how many nodes do I need? And again, this is many, many, many months away. Don't expect, now tilling will start very soon, but compute is not, they never even planned it to start. They have an 18-month roadmap. And again, we're only just barely 4 months into that. Matter of fact, in 3 days, we'll be 4 months in to their 18-month roadmap. So don't expect too much. There's a lot of code auditing and code debt and things like that have to be tightened up. But that's the way I look at it. Like if whatever my allocation is, if I'm interested in hypercycle, if it's on my list, then I look at that and I say, okay, it's about right now 5 to 1. Here's how many tokens I want to have and how many node licenses am I going to need. So you can either grab those licenses now, put them in your back pocket and have them. And the minute you can marry them to tokens and put them into a data center or go park them over at HyperPG, you can fire those babies off and you can start collecting some kind of yield. The tokens themselves, my guess, are going to earn about 9% a year. And again, I'm not going to comment on the price of the token. Let's just talk about the very few things that we do know. So we know that the tokens, just the tokens, will be earning about 9% a year. In some cases more, who knows? It depends on the pools. It depends on the people running the data center and what they're willing to kind of offer, right? But I think that 9% is probably a fair, competitive kind of price or yield. And then you say, okay, cool, there's 9% for the tokens. But if I have the licenses, well, the licenses plus the tokens married together, that creates a scenario where now that little blob, that data center you've created has identity because those node licenses, as your uptime and your compute and your reputation increase, it increases in value because it's increasing in compute, the fees it can charge, all this kind of stuff. So there's an enhanced value. So obviously tokens plus node, probably a double, right? It's probably a double that. And the cool thing is, as the nodes split, you own the node, you own the splits. So I think owning the licenses, if you're looking at, let's say, just the next 6 months, probably wouldn't split by then. But if you look at 12 to 18 months, you're very likely to get a split. Meaning that your return, let's say it was 9% on the tokens in your mind, and you're earning like another 9%-ish because you have the licenses and you've married those. And you get a split. So that 9% becomes 18 plus your 9. You're now getting, anyone? 3 times 9? Anyone? Yes, 27%. And then 12, 18 months later, you get another split. Your 18 becomes 36. Now we're at 45%. So again, if you had just held those tokens, and again, Kevin, I hope this is kind of what you were looking for. If you had just held those tokens, you're racking that 9%, which, by the way, is very good. But we could get into some environment, it's very likely we're going to get into some environment where we're going to have some kind of actual money printing, actual always and everywhere monetary phenomenon of like currency units, because UBI and whatever comes between now and the benevolent abundance of like AGI. But that rocky time in the middle where people are getting displaced and losing jobs and all that kind of stuff, well, that's probably, they're going, I mean, I don't know any other way other than just showering the universe with currency units so that people have money, like some kind of sustenance. And if that's the case, you got to beat 10, 11, 12% just to break even. Therefore, if I have something that can split and split and split, so buying the node licenses to marry with my tokens lets me not only participate in those splits, and again, this is only if you're super like into hypercycle, like a total nerdatron like we are, but you own those node licenses, not the data center. You can book it. You can haul ass somewhere else. You built up that reputation. So basically, they're in your pocket. So I just think the people with the node licenses have the most power. So if I have X tokens, I want to have Y amount of nodes to cover those X tokens. That's the way I think about it. So when I like thinking of investing in hypercycle, and again, I'm not telling anyone to do or not do anything. You do you. But if you're going to do it, keep in mind that those nodes splitting over time, that's the wealth creation, the splitting effect. It's on the data center to scale their equipment, or you can book it and go somewhere else where they will scale it. So that's all I have to say about that. Will the payment from the nodes be in hypercycle tokens? I believe what they're working on now is it will either, you can elect to receive hypercycle tokens, or you can elect to receive stablecoin. USDC, USDT, FUSD. I mean, I don't even know if it, probably USDC, I would think. I don't know. But anyway, that's a hypercycle thing. I can't speak for them, but they are definitely looking at that. Okay. Whew. All right, cool. Kevin the house. Yeah. When we're on Monday, Wednesday, Friday, Kevin, I'll go into detail on the other side of that, the price side of that. As you wish, sir. But on today's the public facing one. Okay. Let's see. Interesting to see Saudi dumping US bonds after they announced they're joining BRICS as a new member. US oil is now breaking to the upside. Interesting. The oil market is an incredibly political, mostly fictitious market. I mean, our reliance on oil will never be zero because you still have to lubricate things. Like these cars don't work with no lubrication. We need plastics and things like that. So we're not going to not, but reliance on oil is kind of the deal. It's like when we're not relying on it. So that could change the whole kind of dynamic. But you know what? Until every flat surface that we see is collecting light photons, we're not there yet. Anyway, cool. Okay. Today, we are going to talk, we're going to do our classroom session. It's going to be on microeconomics. Yes. And I'm just going to kind of go through it. Again, this is more of a 10,000 foot, because I don't want people hanging on a specific word. I want you to get the general idea, the wide paintbrush. Do I have a cool, I think I do have a cool like picture for macroeconomics. I think I found a cool little PDF that we can throw up there. But yeah, today's going to be macro. Yes. Are the splits to the 10th power? Yes. A hypercycle node can split 10 times. And that would mean, I'm sorry. Yeah. A node, once it's running, once it's been infused with tokens, and it is actively tilling, and then eventually tilling plus compute. Because remember, it is uptime. I think it's 1.26, tilling 1.26, your kind of the total kind of score, like the relevant score of that node, 1.26. And as those metrics increase. When it gets to 2, that's a split. It can split 10 times, meaning that if you take 1,024 tokens and you split them, after 10 splits, you're down to 1,024 nodes. So do the math on that. Just do the math on that. If a node license gets you 9%, do the math on 1,024 getting you 9%. Someone want to jump in with that number? 9 times 1,024 is it's a big number. It's a very big, happy number. It's like a lot. And, when you look at these systems, even if you think that hypercycle will only take a tiny little piece of the market is the whole earth. The market is the whole planet Earth. You don't need a big piece of the whole planet Earth. I think Amazon only does 5% of online shopping payment, like shopping. You think, oh, Amazon's everything. It's like 5%. No. That's not 9 times 1,024. You got some decimaling to do, my friend. So, I always look and I try to say, real quick, license gets split, is the license. Yeah, it's the license that holds the value. Now, yeah, because think of the license as like a business. Does that make sense? It's like a little data center. That's the best way to think about this. Matter of fact, do you guys remember we're doing this? We did the what is Bitcoin thing. We did the what is hypercycle thing. I'm doing, by the way, this is one of the classroom things that we're doing for every single one of these projects. I'll just go over this again, but again, what is hypercycle? You got to be able to explain it to yourself. Yes, that's right. That's right. And you do that math on any number and it's a badass number, my friend. It's a badass number. It's a good number. What is hypercycle? Hypercycle enables, so just think about this for a second. Hypercycle allows AI systems to communicate and collaborate efficiently. Right now, as you guys know, that is a very slow and costly process. It's incredibly costly. That's why there's this AI chip and compute arms race. Hypercycle improves this whole kind of thing by offering a secure global connection system. And that's us. That's us as all the nodes, all the little node licenses with their tokens embedded in that's the global connection system with verifiable identities to prove who's who without depending on any centralized party. No AWS, no Azure cloud. Does that make sense? No cloud. This is a full kind of, it's like, I think of it like drawing a bunch of dots on a balloon, blowing the balloon up, more dots. Look, pretty soon you've expanded the entire planet and all those little dots are nodes. That's us. We are those dots. And every time a transaction goes across one of those dots, you put money in your pocket, right? But none of it depends on any one centralized entity. So this creates a safe platform for artificial intelligence and AI devices and AI workloads to interact directly without intermediaries. And there are all sorts of applications that are not just specific to AI without getting into it. Many of you can kind of read into this and you can see where this could go. Many of you that are kind of looking close at hypercycle, the idea of a ledgerless blockchain-based system like a layer 0. You think, well, layer 0, that would be beneath a layer 1. Yes. So a layer 1 might choose to process transactions across a layer 0 when it's faster and more elegant. Yes. And typically business goes where there's less friction. Yes. And where there's more money to be made. Also, yes. So if you kind of game it out a little bit, and again, no guarantees, but like a little common sense. Okay. There we go. Yay. All right. So let's do some classroom. Let's talk some micro, not macro. let's talk some microeconomics, which we love us some micro. So sit back and relax.
Hello. You're late.
You're bad at math, but I'm giving you an A+ in confidence.
Just doing what I gotta do.
Extra credit.
Rick and Morty, man. So good. Okay, let's talk some micro. So let's talk about the importance, kind of some of the implications, and then the limitations. No one system. This is important. A lot of people, they kind of get caught up in, okay, if I know this, then I understand everything. If I know this, that's not true. You do need a kind of a wide paintbrush in modern economics. You need to understand micro and macro, and you need to understand the basic idea of capitalism and, kind of, for those of you that haven't kind of studied what the true capitalist is, the person providing capital or the entity providing capital so that businesses can expand, you probably want to look into that. And just real quick, Hayes, just be very careful. Hayes is maybe one of the biggest counterfeiters in human history. And I like some of the things he says. Again, he's very smart. He is a visionary, but he's specifically corrupt. So just be very careful. I mean, it's one of those voices. I'll tell you this. I trust Arthur Hayes way more than I trust Mike Novogratz, because at least Hayes is honest about his theft, and Novogratz's theft is through stupidity. Let's see. Hayes argued that AI companies, due to their significant cash reserves and robust revenue streams, are less reliant on banks. Well, I think that's true of anybody that doesn't need to rely on loans and lending and investors. That's why a lot of these companies are still private. I mean, I was going to mention a little bit about, I guess I don't really have to, you guys probably get it, but for the DPC's twin protocol, there's going to be a second round. I'll have info on that this week, maybe even today. And then on True AGI, their second round is being set up, but that's equity only. And again, that's accredited investors only, and that's a digital. But anyway, those two things are coming. So yay. All right. So let's get back to the micro. So we're going to talk about the importance of microeconomics, implications, the drawbacks. So you can't over rely on it. So imagine you are a savvy investor. You're always on the lookout for the next big opportunity, and you carefully analyze market trends, and you study financial reports, and you keep a close eye on the global economy. So you're trying to look at all the gears. But do you ever stop and just think about the underlying principles that are driving the markets? Not the people, the principles that the people rely on for making their decisions. And this is where microeconomics comes into play. So in this kind of discussion, we're going to delve into the importance of micro, small economics, little e, and its implications for investors like us, and the potential drawbacks that you should be aware of and kind of not to over rely on. Microeconomics, as the name suggests, it focuses on the individual components of the economy, right? Like looking through a microscope. It examines how the decisions made by individuals, households, families, businesses, how those decisions impact resource allocation, pricing, and overall economic activity. So by understanding microeconomic principles, kind of, again, those basic broad strokes, then we can get a valuable insight into the dynamics of these markets, and we can make more informed investment decisions than the fat kid at the campfire, right? And it just helps us to navigate a pretty complex world of finance with greater confidence than like the douchebags that get on CNBC and just scream stupid shit. So like in any field of study, microeconomics obviously has its limitations. So while it provides a valuable framework for analyzing markets, it does not account for all of the factors that influence economic outcomes. Microeconomics isn't a formula where you put in 6 and you get out, invest 4.3. This is not that. Because it's like all of these small portions of your financial education, no one piece, other than game theory, there's no one piece that spits out answers. So you basically stack all of these things, macro and micro and basic financial principles on top of game theory. You stay out of the way of your cognitive biases, and you can spit out investment decisions, or at least help you express your investment ideas into like actionable stuff that you can like pull the trigger. So it is essential to recognize that there are drawbacks and supplement macro and microeconomics analysis with that broader perspective. So you got to sit back, right? You want to incorporate macroeconomic factors and other qualitative considerations. You can't, none of this is done in a vacuum unless you're the Fed, right? And we see how well that works. So it's not enough to like have a Phillips curve, and that's the whole economy. So what is the importance of little e economics? So microeconomics plays a crucial role in the shaping of our understanding of how markets function and how individuals and businesses make their kind of very narrow decisions. So by examining the behavior of buyers and sellers, microeconomics helps investors identify patterns and predict market trends. So there's kind of three key reasons why microeconomics is important for investors: pricing strategies, resource allocation, and just basic decision making. So pricing strategies, you would think, okay, microeconomics is providing insights into how prices are determined in different markets. So by analyzing factors like supply and demand, right, you reduce it to the simple. You look at elasticity of the market, elasticity of the currency, devices used in that market, the structure of the market, which can be rules and regulations. Investors like you and I, we can gain a competitive edge. And again, most people just aren't thinking about this stuff. They're not thinking about thinking, right? They may like, oh, supply and demand, it's simple. So sometimes you have to step back and think about your fundamental, like the foundation that supports your basic ideas about supply and demand. So understanding pricing dynamics, it allows investors to identify undervalued assets. We're always about the value, not about the trade. It allows us to anticipate changes in pricing trends and make profitable longer-term investment decisions, right? So we're not just like on a racetrack. It's not about the next turn. It's about many, many turns, many, many laps, many, many hours of driving, and then hopefully you don't crash. Okay, so let's talk resource allocation. Microeconomics helps us understand how resources are allocated within specific markets. So by examining factors such as production costs, efficiency, market competition, we can assess the sustainability and profitability of businesses. Many of you own your own business. So many of you are dealing with this all the time. And you may not realize it, but you might all be microeconomics experts based on your day-to-day business dealings. So the kind of knowledge that you gain by understanding efficiency, market competition, sustainability, and profitability of a widget that you might be selling, that knowledge enables like us as investors to identify industries or companies. And we use the 5 T's, right? But it lets us identify potential assets that could be strong growth prospects. And then we can look at them and say, are they allocating their resources correctly? Do we trust what they're doing? And that's part of our 5 T's, looking at the team, looking at the technology and the timing and the token structure, and then asking like, why does this token exist, right? And that gets us back to decision-making. So if we understand their pricing strategies, if we understand their resource allocation strategies, and those all seem okay, then microeconomics provides a framework for analyzing individual decision-making. And it helps us study consumer behavior and business strategies based on consumer behavior. We can anticipate how changes in economic conditions, like where we're going into this kind of deeper, more obvious recession that at least people are finally starting to admit to. So we can kind of look at changes in economic conditions and changes in consumer preferences. How much am I willing to go out and eat now that the economy's tightening up? Not as much as I was during COVID when I was getting that free money, right? So like when those when those consumer preferences start to change because of economic conditions, it will obviously impact what we see as investment opportunities. It will impact our value estimations of these assets. So kind of having this understanding allows us to make more informed decisions based on a deeper understanding of market dynamics, not just Phillips curve. So let's talk about the implications for us of microeconomics as opposed to like the big macro. The implications of microeconomics for investors like us, and again, I keep saying investors, not traders. Sometimes an investment will become a trade when the information changes, but I believe you should go into everything with a longer time horizon, not just trying to get in, get out, but what is going to get you the most return on your pile of cash units, what's going to help you beat inflation debasement effects by the biggest number. How do you get the biggest multiples? So for us, like an understanding of micro, it's pretty important. So armed with a solid understanding of microeconomic principles, we can navigate markets much more efficiently, and we can increase the chances of success. Remember, there's no like guarantees in any of this investing stuff, but you can increase your chances. The more at bats are likely to get you on base more often, right? If you have a fundamental understanding of microeconomics. So what are the kind of key implications for microeconomics for investors? And why should it, like you're listening, you're like, why do I even care? Well, identifying investment opportunities, assessing risk and the possible returns, and understanding a competitive advantage, like when you see it in the market. So let's go to identifying investment opportunities. In microeconomics, it helps us identify investment opportunities by analyzing inefficiencies in the market. If you see somewhere in the market where you go, that's screwed up, and then you see over here, oh, these guys solved that. Now you see a situation where something might be undervalued or not valued at all because the market hasn't come to realize that this group over here could solve that thing over there, that friction. So by understanding supply and demand dynamics, we can identify market imbalances. We can capitalize on them. You want to see market imbalances in real time, just go look at liquidity pools. That's market imbalances, pricing differences in real time being arbitraged. This is kind of cool. So you can go look at it like in real time if you're really bored. Anyway, but being able to identify imbalances in markets and capitalize on that, that's like the key to being a value investor. So for example, if the demand for a particular commodity, like Bitcoin, say, exceeds its supply, so demand is constant, supply decreases, or demand increases, supply stays the same. Either way, investors can expect prices to rise and they can invest accordingly. Maybe they can invest directly in the asset. Maybe they buy the ETF. Maybe they buy options on the ETF, or they buy futures, right? That's how you express you take your investment thesis and then you express it as a trade in one of those different financial tools. All right. Assessing risk and return. Microeconomics helps us assess the risk and return of potential investments. So by looking at factors like the competition, we call them like industry similars, right? Like you look at layer ones. Okay, who do we got? We got Ethereum, we got Cardano, we got Cosmos, we got Near, we got, I guess we could say Algorand. But you go down the list, right? And you can look at industry trends. You can gauge the profitability and the sustainability of those various assets. And this lets you make more informed decisions. And also, when you're dollar cost averaging in or out of an asset, your kind of opinion over the potential profitability of these companies, or at least the asset appreciation in the token, will it get used more? That helps you know whether it's time to continue to invest in an asset or it's time to wind it down. Like if the information's changed, and that could just be that the team is a lot less hungry, a lot less interested, like Ethereum, where no one cares because they're rich and layer twos do everything, and they don't need to innovate at all. And they've even admitted it, and people still buy it. It's mind-boggling. All right. And then we need to understand competitive advantage. So microeconomics allows us to understand the competitive advantage of one business over another. So by analyzing things like cost structure, pricing strategies, looking at the market cap of these assets, looking at the yield that they may offer in staking, things like that, we're looking for projects that have some kind of sustainable competitive advantage, not just spewing out tokens because that's part of your marketing budget, but who has a sustainable competitive advantage over their peers. This helps us identify companies that are more likely to generate longer term return, longer term asset appreciation, and to continue to deliver on that, not just fold their shit up and haul ass. All right. Now let's kind of, hey, shut up, Siri. This is weird. Like, they're always listening. Like, oh, my phone doesn't listen. Oh, your phone listens, bro. Listen to everything. You talk, listen, you want to, no, I'm saying there's a little experiment where you spend 5 minutes talking about hair care products, and you'll start getting served hair care ads when you're like, wait a minute, that's a coincidence. No, bro, it's not a coincidence. Anyway, let's talk about the drawbacks of microeconomics. Sometimes you can be too kind of microbial in your vision of the market, right? You don't want to get too narrow. You don't want to put blinders on like a horse. So while microeconomics provides a lot of insights, it's important to recognize that there are kind of three basic limitations. One, you oversimplify your assumptions. So that's not always wise. You overgeneralize. This is what most finance people do. They just reduce all of their thinking to like one or two little switches. Did we go slow-mo? Yeah, I don't know what it is, but this happens a lot, and there's nothing that can be done about it. So anyway, you know what? I'm just going to go, because it's so freaky, I'm just going to go to here, because I think the audio is still fine. I don't know why it does this. I've ordered 75 of these stupid little plug-in boxes. I don't know why that happens, but it does. Anyway, so the drawbacks, the main drawbacks that we need to talk about in microeconomics are that it simplifies our assumptions, that we might ignore macro factors, and that it gives us kind of a very limited predictive power. Microeconomics is more about how people behave and less about what they might do in the future, because that necessitates the macro picture. You need the macro framework. You can't do all of this in a vacuum like the Fed. We'll just never be that successful. No, like that level of magical success. Anyway, let's talk about simplified assumptions. So in macroeconomics, it tends to rely on very simplified assumptions to model very complex economic phenomena. So these assumptions, while they're, obviously necessary to simplify your analysis because there's just so much information, it may not capture the full complexity of real world markets. So we need to understand that, and we need to be cautious not to rely just on microeconomic models. It's not just supply and demand curves and everything else. Just here's the answer. It's not that simple. We need to consider factors that impact like long-term outcomes of investment. So what might that be? Well, when you ignore the macro, right? When you ignore the macroeconomic factors, like you can't do all this without considering, are we in growth? Are we in a recession? Are we in a depression? Like those business cycles, they matter. They're very important. And thinking is quite heavily influenced by that and behavior and dynamics. So microeconomics focuses on the individual units of the economy, right? The micro. And it often overlooks the broader macro factors like inflation, interest rates, government policies, government interventions into certain markets, regulator interventions, #SEC, into certain markets. And so investors, we have to supplement our microeconomic analysis, again, understanding the tiny, with a greater understanding of the macro trends so we can make more well-rounded game theoretical investment decisions. And all you have to do is just be ahead of the crowd by about 6 or 8 months to make big multiples. You can go with the trend, kind of indexing your way in and out of things, but you're never going to really win on the multiples unless you're about 6 to 8 months away, out in front of the crowd. Again, you're at the beauty pageant and you're guessing who's going to win the beauty pageant for whatever reason before the crowd does. And if you can do that 6 or 8 months ahead, you're going to win on a pretty regular basis and you're going to win multiples. That's kind of the key. Microeconomics, because it's so narrow, because again, it's studying that in the tiniest individual units of the economy, it doesn't really guarantee any accurate predictions. Economic variables are influenced by a bunch of different things, and it makes it very challenging to predict market outcomes solely based on supply and demand curves, yesterday's price behavior. This is why mostly technical analysis fails. Now, there's a couple of outliers. Like if you make a prediction 700 days in a row, you're likely to get it right 1 or 2 times. But mostly technical analysis fails because it's too limited in its scope. So its predictive power is limited. It's just looking backwards. You can't, for the race car analogy, you can't win a race by driving with your focus in the rear view mirror. Yeah, you know what the turn behind you looks like. It's not going to set you up for the turn in front. Anyway, so economic variables, they're obviously influenced by all these different factors, right? And it makes it like almost impossible to predict outcomes based on the past and based on microeconomic analysis. Again, another reason why the Fed doesn't work, because you can't, the Phillips curve is not robust enough to manage the entire effing economy. Anyway, we have to consider qualitative factors, market sentiment, external influences, just bigger macro factors in order to enhance our investment strategies. So kind of to wrap this all up, microeconomics is a powerful tool for investors. It gives us insight into pricing strategies. It lets us look at resource allocation, decision-making. It helps us stay informed with our investment decisions, with the tokens that we own, with the yields that they pay, with the teams and the timing and the technology that they're working with. But again, these are all micro factors, micro, little e. And it's essential that we have to recognize that this is still a limited view of the market. It's a very valuable one. And without it, you miss everything. But it alone is not enough. So recognize the limitations of microeconomics, but as part of your kind of broader investment framework, it's incredibly important. So by combining microeconomics with macroeconomic analysis, that large brushstroke, qualitative considerations, look at market sentiment, we can enhance our ability to increase our percentages of success, because there's no kind of one click to success formula. It's just, we give it our best. And if we do more research than the guy next to us, we're more likely to succeed. Not guaranteed, but we're more likely to succeed. All right. I don't know why. What difference would it make if we're an hour into something or not? Like, what difference does it make for my computer? It's so stupid. Anyway, we're not there yet. Come on, AI. Come on. Anyway, stay in school. Don't do drugs. We'll see you tomorrow for Digital Investor. Yeah, take your time, do your research, do your reading, think about thinking. Don't just think about outcomes and flipping and getting paid and buying airplanes and a bunch of other bullshit. I think you need to consider that you have 18 to 36 more months to participate in investment markets before the robots are doing everything. And once they start handing out UBI, the chances of you jumping into a higher tier, a socioeconomic tier, is very, very limited. I won't go into detail on that today, but if you do the math, you end up in a caste type of a system, and that doesn't usually work out well for everybody that's not in that top slice. So that's where we want to be.
If you're an accredited investor and you want in on angel, seed round or early round equity and token opportunities in the artificial intelligence and cryptocurrency space, schedule an interview at nickblacknext.com. In life, you can either be really good, really lucky, or just be first. Being first is so much easier. Schedule a digital private client interview today at nickblacknext.com.